All right, let's get right into it and take a hard look at the actual financial mechanics behind buying a home. I mean, for most of us, a mortgage is literally the biggest financial transaction we're ever going to make, right? Yet, it's kind of crazy how the inner workings of these loans remain a total mystery to so many people. So in today's Explainer, we are diving deep into the exact math, the jargon, and the real-world strategies drawn from the latest financial data. We're going to figure out what you are truly paying for.
You probably have your mortgage set on autopay, right? The money just magically leaves your checking account every month and you get that nice sense of pride knowing you're building equity. But have you ever actually stopped, pulled up your statement, and looked at exactly how much of that hard-earned cash is really going toward owning your house?
Well, the shocking reality is that during those early years of your loan, the vast majority of your monthly payment is going straight into the bank's pocket just to cover the cost of borrowing. You might be writing a check for, say, $2 or $3 grand, but only this tiny little sliver is actually knocking down the principal balance of the property. The rest of it, pure interest.
Here is our agenda for today. First, the hidden cost of mortgages. Second, how interest is calculated. Third, choosing your mortgage type. Fourth, the true cost of rates. And fifth, how to lower your rate.
Starting right off with Section 1, the hidden cost of mortgages, decoding the jargon.
Okay, so the main culprit working against you here is a term called amortization. Basically, because of amortization, your loan balance is at its absolute peak right at the start of your term. So the interest, which is calculated against that massive starting balance, eats up almost your entire monthly payment before it even gets a chance to touch the principal. It's really only as you get way closer to the end of your loan, years down the road, that the math finally flips and most of your payment starts actually going toward the house itself.
And that brings us to an absolutely crucial distinction, the base interest rate versus the APR. Lenders love flashing a super low base interest rate at you, but that's just the raw percentage they charge to borrow the cash. The annual percentage rate, or APR, is the number you really got to pay attention to. The APR is the whole shebang. It includes that base rate plus origination fees, closing costs, discount points, everything. It gives you the true total cost of borrowing on a yearly basis.
Moving right along to Section 2, how interest is calculated. Doing the math.
Let's anchor this with a real-world example from our data. Let's say you have a remaining loan balance of exactly $150,000, and your interest rate is sitting at 6.25%. Okay, the lender takes that annual rate, divides it by 12 months, and gets a monthly rate of about 0.52%. When you multiply that by your $150K balance, you are paying a staggering $780 just in interest for that one single month. I mean, wow, that's $780 literally vanishing into thin air, doing absolutely zero to pay down your actual debt.
Let's head right into Section 3, choosing your mortgage type, rules of the game.
So with a fixed-rate mortgage, your interest rate is locked in forever. This gives you a ton of peace of mind because your principal and interest payment, it's never going to change. That makes it the safest bet for sure if you're planning to stay in the home for the long haul. But quick caveat here, your total monthly payment might still jump around from year to year. Why? Because property taxes and homeowners insurance, which usually sit in an escrow account paid by your lender, definitely tend to creep up over time.
On the flip side, we've got adjustable rate mortgages, or ARMs. Now, a typical 5/6 ARM starts out with an introductory, lower fixed rate for the first 5 years. It's kind of like a honeymoon phase. But once that 5-year mark hits, your rate adjusts every 6 months based on whatever the current market is doing. If rates drop, awesome, your payment goes down. But if market rates skyrocket, your monthly bill is going right up with them. It's a calculated risk, usually only a good idea if you know for sure you won't be keeping the house very long.
Next up is Section 4, the true cost of rates, the $400,000 reality.
You've really got to look at the sheer volume of money on the table here. On a standard $400,000 mortgage with a 30-year term, if you lock in a 5% rate, you're paying about $373,000 in total interest over the life of that loan. But let's say your rate is 7%. Suddenly, your total interest paid balloons to over $558,000. So that tiny 2% jump doesn't just bump up your monthly bill. It literally forces you to hand over nearly $185,000 more to the bank over 30 years. That is a life-changing amount of cash, all dictated by a fraction of a percent.
And checking out how your down payment plays into this is just as wild. On a $400,000 home with a 6.5% rate, bringing a 20% down payment to the table up front slashes your total interest by over $100,000 compared to putting zero down. Why does that happen? Because you're simply borrowing less money from day one, which starves that amortization math we talked about earlier. Less principal literally means less fuel for the interest fire.
Finally, Section 5. How to lower your rate, the playbook.
So first things first, aggressively work on that credit score. Lenders save their absolute best terms for folks with scores at 740 or higher. Second, pay down your existing revolving debt like credit cards to lower your debt-to-income ratio. That makes you look like a much safer bet. And third, like we just saw, scrape together a larger down payment if you can. When lenders see you've got real skin in the game, they see lower risk and they reward you with a lower rate.
If you want to get into some advanced plays, think about this. You can instantly slash your rate by choosing a 15-year term instead of a 30-year. Banks charge less for shorter terms because they get their cash back way faster. You could also buy what are called mortgage discount points, essentially paying interest upfront at closing. Usually 1 point costs about 1% of the loan amount and permanently drops your rate. Or, and I know this sounds obvious, but just buy a less expensive house. Borrowing less is the ultimate way to cut the total cost of interest.
So, armed with all this knowledge about the massive compounding power of amortization and rates, we kind of have to look at homeownership through a totally different lens now. Ask yourself, when you write your next mortgage check, are you actually paying for your house, or are you just renting money from the bank? The goal here is to strategically structure your next loan so you're building your own wealth, not just enriching your lender.